Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
You're listening to the best of The Money Show.
The Money Show.
Welcome to the best bits of The Money Show, a digest of some of the most important insights, thoughts, comments. Unfortunately, not as many jokes as we would like from this week's edition and editions of The Money Show. If you'd like to hear more, please go to our website or your podcast app and search for The Money Show. Might be worth sending it on as well to someone who you know who you think could benefit or maybe really does need to hear what was said. To start, some of the news stories that we thought were very important this week. The Reserve Bank Governor, Lesetso Kganyago, and the Central Bank's Monetary Policy Committee cutting the repo rate by 25 basis points, reducing the cost of borrowing and debt, and talking about lowering the inflation target. It does look like we're going to have more conflict, contestation, pick a word, between the minerals industry, the mining industry, and the government. The Minerals Council warning the Minister, Gwede Mantashe, over a potential clash over delays in mining rights, regulatory uncertainty, and the mining cadastre system, but new proposals do seem to be a little bit confusing. And the bromance, call it what you will, between Donald Trump and Elon Musk appears to be breaking apart. Musk is beginning to criticize some of the Trump administration's decisions. Tonight, we bring you a mixture of stories from the world of money from the week that has been. In this week's episode of How I Make My Money, we focus on the business of wellness and fitness with Lisa Raleigh, founder of the Lisa Raleigh Group, speaking about her fitness empire built through programs like Bounty and how she was able to go from literally putting pamphlets under car windscreens to the group that she leads now.
Auditions were out. I submitted my CV. I had to do a one-on-one with them. I had to motivate an obese client that I had never met before. I had to speak on camera. I'd never done that before. And I must be honest, I was lucky. And it was my time and it was my turn. And I got this amazing platform in which to showcase what I was passionate about. And I will forever be grateful to that show because not every single personal trainer, fitness, enthusiast gets the opportunity that I got to be on such a platform. So I embraced it with all of me. And after I'd done the show, which was 12 weeks of vigorous shooting, I almost lost my business at the time because what we signed on the contract and what we actually had to deliver was two very different things. I mean, I was on set all day, all night, weekends. It was intense. And I still had 3 gyms at that stage to run and staff and clients. And it was really intense. It was probably the most stressful yet rewarding time in my career. I just remember being so stretched and it was really tough. Anyway, when I'd finished the show, within weeks of finishing the show, my phone blew up, my emails, my website, of people asking me for the same experience. I lived in Durban at the time and the entire show was shot there in the North Coast. And people just begging me, please, I want what those Biggest Losers had. I will pay anything. I'll come and live in Durban if I have to for 12 weeks or 6 months. Please change my life. So I actually put together a beautiful weight loss and wellness program, and I developed that into something that I could duplicate. And then I just got a little bit frustrated selling time. And I think that for me was a big lesson. Many years ago, I was like, I am never going to be able to help all the people in the world that I want to help if I'm putting a price on my hours. And so I just started developing online platforms, online tuition, online programs, things that were duplicable, things that could scale, things that people could do around the world and in any room, on any platform. It was just for me, I needed to be in everybody's lounge. I could not just have people come to me and sell every hour of my day. So that whole show gave me that opportunity to be on television, to be seen by lots of people all over, and then to use that platform for further television and further radio and further articles and a life in the media, really, that I was able to take my vision into people's homes. And I will forever be grateful for that opportunity.
It's interesting you talk about the reaction to you winning the show, people saying, I'll move to Durban. I mean, gosh, I'm in Cape Town at the moment, and I know some people who just refuse to move to Joburg no matter what happens, despite my best efforts. There's a kind of a desperation. I mean, people are desperate for many things, but part of it is controlling their own bodies and controlling their own lives.
Yeah, well, I mean, ultimately, isn't your wealth your health? I mean, when you don't have your health, then you have one really big problem, right? It's like you can't do anything or enjoy your life, or work properly, have relationships, experience, travel, do anything if you don't have your health. You literally, that's all you worry about every single day. So people are desperate because they're not necessarily living their best quality of life. They want to learn how to be better. They don't want to be bedridden. They don't want to be relying on medical savings and going to the doctor every 5 seconds. I see a lot of really unwell people every single day. And they are a mirror for me to uphold my lifestyle because they show me every day that if I don't look after myself and put myself first and be selfish to be selfless, and that has been my motto for many years, guys, nothing else matters but your health, because when you don't have it, then you have nothing. So I try as best I can to tell people that when you put yourself first in the morning and you make yourself a lunch, or you give yourself 15 minutes for breakfast, or you spend time exercising and you tell your whole family, listen, this is my 30 minutes. When you claim it and you prioritize it, you should be feeling like this is the most selfless thing you're doing, because it's actually enabling you to live your best life, to be productive, to thrive in business, to be a good partner, to be an energetic mother or father. It should be, everybody should respect you for it. And what I am finding, compared to 15 years ago 20 years ago when I first started my career, if you were in the health and fitness industry, it was kind of like you were vain. You're a musclehead, or there were all these labels, like you're a freak, and you must be so into yourself, and you put your fitness and your health above everything else. But now the narrative is definitely changing. I've seen it change, especially in the last 5 years.
Sure.
People that are saying, sorry, I can only start my meeting at 8 because I have a trainer, or I go to a class, or whatever it is. Like you look at those people like, bravo.
Yeah.
You're actually putting your health first, and it's becoming this thing to be respected. So that's been amazing to see.
Yeah, no, I mean, it's been a real transformation. I've got some more questions about that in a moment. I do want to just go back a little bit, maybe just to before the television show. You said you had 3 gyms then. How did you open the first one? Where did the money come from? And I ask because there is a lot of competition. There's sort of some 1 or 2 that dominate. You have to take them on. You have to provide something that they don't, and they come with more money than you do.
Yeah. Well, let's just go way back, because I was 19 years old when I started it. So that I'm 42 now. Oh, my goodness. So 23 years ago, having a personal gym, having a private gym at home, having clients, it was not nearly as common as it is today. There was no social media at all. There were no fitfluencers or influencers, and very few little private gyms anyway. So I was like one of the first in KZN. I had gone overseas to Wales, and I had done some experience over there. I'd studied and then went over there as working as a personal trainer. And why Wales? Because my boyfriend at the time, he was a rugby player and played for like a club there. So I went there and I lived there for 2 years, and I got some cool experience, came back and then started a mobile personal training gym. So I didn't have the funds to set up, a R500,000 gym. I couldn't do it. So what I did is I had my little rusty Corsa, I remember it so clearly, and a couple of pieces of home gym equipment that were easy to travel with. So one was actually a rebounder, believe it or not, which is something that I'm known for now. An exercise steps, some weights, skipping ropes, some dumbbells, some stretchy bands, resistance bands. And I started with my mom's best friend, and then she told a friend, and then I put pamphlets underneath car windscreens.
Sure.
I had like my little, promise you, I've still got the first flyer that I ever made. It had a tape measure like stuck on it, and then I photostated that. And that's what I did. I just marketed myself, and I got 4 clients, then 8 clients, then 12 clients, and I would drive to their homes, unpack everything, put on music, give them a workout, pack it all back into my car to the next client. And so that happened for about a year until I got a bit frustrated, driving around, traffic, accidents, And so I got my parents' home that I was living with at the time. I was 20, I think, at that stage. I asked them for a room, if I could please have a room, and then I would convert that into my little gym. And they were very happy for me to do it. They were very serious with me, though. I had to pay rent. I had to pay my way from the get-go. I mean, nothing was for free. So that's a good lesson that they taught me from a young age, to be responsible. And my kind of relationship with money goes way before that, also with my mom and dad. But anyway, So I started like that until it became a little bit too busy, and I had like a waiting list, which was amazing. And it was really just word of mouth. I didn't have money for marketing. There was no social media. So a friend would tell a friend, bring 2 friends, and before I knew it, my little gym was packed. And then I got premises. And when that gym was packed, I got a second space, like further up in Hillcrest area in KZN. And then I had a lot of Muslim clientele. Like I had probably 80% of my clients were female Muslim ladies, and they couldn't be seen by men.
Yeah.
So what I did is I opened up a women's only facility called Go Figure at the time. And so I had 3 of these gyms that I was running, and I did that for about 5 years, every day, every night, every weekend, and I had loads of trainers working for me. And then I got this opportunity on The Biggest Loser, and that just catapulted me to another level.
It's amazing
so, I started with just, I think probably 8,000 Rand. I think that's how much I had in my bank account, and that's what I had to buy my home gym equipment. Yeah.
It's amazing. I mean, the idea, Lisa, that you were literally putting, leaflets under people's windows. I mean, I love that on people's windscreens and things, and very much involved in
post boxes. Can you believe it? Like in my neighborhood post box.
I can't imagine that. So one of the things, I mean, this is going to sound like such a strange question, but okay, so you were younger then than you are now. You're still, I'm sure, a lot fitter than I am. But when you spend the day exercising, I mean,
yes,
that must be, I mean, when I talk to people my age, and I'm not that much older than you, I'm in just the same decade that you are, and someone will say to me, if you had a weekend to yourself, if, my children and my wife are away and I don't have to do anything, what am I going to do? I'm going to exercise. I'm going to get on my bicycle and go, and I know exactly where I'm going to do it. I'm going to go for as far as I can and all the rest.
Yes.
But when you're exercising 5 days a week, what's that kind of like? I mean, do you ever get a bit sick of it? Do you ever wake up in the morning and think, actually, I can't do it today? Do you actually get to the end of a week and think that was great?
Yes. Okay, so before, let me explain. So when I was a lot younger and when I was doing this private gym situation, the type of exercise that I did was land-based. So I did everything with, weights, functional training with weights, and I did, your normal personal training. Then, you use your cardio equipment. So you use your treadmill and your bike and your stationary equipment. That for me is like a hamster on a wheel. Like I cannot do that kind of training anymore. And then I used to run. I used to run outside a lot and therefore quite injured a lot of the time, like a sore knee while I was going to the physio. So like that was the kind of exercise that I was doing for many, many years. In fact, 2 decades. And always nursing an injury, always putting it off. I felt like the only way I could really exercise if I was like trying to train for a race, like a reason, or with my clients in like a class environment or something like that. I really didn't enjoy it because I was always in pain. The exercise that I now do for the last 8 years, which is the only kind of exercise that I do on a daily basis, is something that is pain-free, it's low impact, it's super fun, it's music-based, and it's resistance and cardio in one. So it's like time effective. And that's rebounding. That's exercising on a mini trampoline. I've literally just got off a rebounder now with 50 people in my class. It was epic. Like the energy in the room, everyone's bouncing, everyone's smiling, no one's in pain. I cannot even describe to you how different this type of training is. And for me, I never procrastinate or put it off. And I don't actually spend the day training. I only train 1 hour a day, never more than that, like never. And the rest of the day, I actually shoot content we've got a big subscription service.
Sure.
So we're shooting content all the time for that platform, for our clients that are global now, to be able to exercise in the comfort of their own homes. And what I've done is I've had a course running for about 5 years. I've trained about 650 instructors now globally. And that instructor course, I handpick trainers that I've found, like in Joburg, because I'm in Joburg at the moment. And those I've handpicked and hand-reared, and they've brought their own beautiful principles as well and their own energy, and we've applied all the Bounty principles. Bounty is the name of my rebounding business. And now I have a ton of instructors. So I don't have to take 5 classes a day, 10 classes a day. I do 1 class in the studio 3 times a week. And the other times I'm shooting content. And they take the classes because I knew that selling time is not the way to be financially free. I cannot do that. And also, you're enabling other people to own their own business, which is awesome. It's a great feeling.
That was this week's episode of How I Make My Money, featuring Lisa Raleigh, sharing the story of her journey in the fitness industry.
7:02. You are listening to The Money Show's best bits.
In our personal finance this week, Warren Ingram, financial advisor, co-founder of Galileo Capital, looking at the issue of diversification in investing and particularly the importance of maintaining a balanced portfolio with a mixture of shares, bonds and cash to mitigate risks and achieve long-term financial goals.
I think especially when they've gone well for a while, we tend to start feeling rather clever with ourselves and impressed with how we can make so much money by just letting our stock market investments run and run. And it becomes an easy game, this investing thing. These runs in the stock markets can carry on for quite some time, sometimes up to 5 or 6 years. And it can lull us into a sense of false security where we think, we're going to get rich, we're going to get to retire quickly. And all of a sudden, one day, the wheel turns and everything stops. And we won't know why that happens. And usually it's not going to be something we can foresee. We wouldn't have been able to foresee, for example, the financial crisis that happened in 2008, the drama that actually unfolded. We might have enjoyed the long stock market ride from 2001 to 2007, and maybe we were a bit worried about share prices being expensive and the like. But the dramatic almost stop of the stock market and then the fall off the cliff would have caught most people, if not all of us, by surprise. And I think it's important that we know that when we're investing in shares and it's going well, it's very easy to become complacent. And when that happens, people like me saying, hang on, just be careful, spread your investments across different types of assets. We start to sound like a stuck record and people think you're kind of old school now and fuddy-duddy, etc. And until the market does take a big hiding. And I think we all saw that firstly in COVID, and then a year and a half later when the interest rates went through the roof and stock markets fell out the bottom. So the answer is we've got to be very careful. We need to be in the stock market. It is the best place to get good capital growth over a long period of time. But if we don't spread the risk, and especially adding in government bonds, we get to a situation where we could see dramatic losses in our money.
Okay, so when markets crash, all sorts of things happen, and we've seen a little bit of evidence of that quite recently. That obviously does terrible things to your investments.
It does. So maybe to give you context, because I think what I've realized is as human beings, we're not very good at understanding percentages. So let's just say we've done well and we've built up an investment in the stock market of 5 million rand, and we were very happy with life. In a typical market crash, so not an extreme market crash, but a very typical market crash, you would see the stock market lose about a third of its value within the first year of a big crash. So if you've got 5 million invested, that means by the end of 12 months, you're sitting on 3.3 million rand. And for most South Africans, just the loss is more than they'll earn in a very long period of time. So it's not a loss. That size of loss is not something that most people are built to deal with. It's a psychological ability to tolerate risk, and very few people are able to deal with that kind of size drop. So what happens, and it happens almost en masse, is most people who are entirely invested in the stock market after a big drop like that won't stay invested. They won't ride out the storm. They'll actually sell out. And they get to the point where their tolerance for losses and their tolerance for listening to the argument to be patient, etc., gets to breaking point, and they sell. And usually what happens is they transfer the money that was in shares and they put it into cash and hope for some form of interest just to stop losing money, and maybe that they start to get a little bit of growth on whatever they've got left behind. And unfortunately, it seems we're very good sort of anti-predictors as a market. When investors do this en masse, we tend to make that big switch just before things start to recover. And so the tragedy is that people sell out and then the market starts to recover. It takes about 2 years for those losses to be erased. And in all that time, the people that sell out are sitting in cash waiting for things to get better. And the way that they judge that things are getting better is because you and me, for example, will be talking about the stock market starting to recover, and companies are reporting better profits again, et cetera, et cetera. And by the time that filters through to all the investors that have sold out, they've lost out on all of the recovery of the market, and then might be tempted to go in again. And often they go in just before the next big drop. So it is a vicious cycle when you entirely invest all your money in shares and then don't ride out the very bad times.
Okay, and I mean, obviously it's difficult to know exactly what's going to happen. All right then. So when you mix your shares with bonds, how do you actually do it? I mean, what changes?
What happens firstly is that the losses get limited severely. So instead of losing, your 5 million going to 3.3 million, if you've got a classic mix of 60% in shares, 40% in bonds, suddenly that drop goes from 5 million to 4 million. And for some reason, psychologically, most of us can tolerate a loss like that. And that's the critical point here is it's about what we can deal with. None of us like losing money, and none of us are going to be very happy when we see our statements. But where is the point where we can actually stay invested and ride out the drop so that we can participate in the recovery again? And it's somewhere around that 20% number for most of us as human beings. And it's not really related to our financial literacy or financial education or even how bright we think we are. It's just the inbuilt psychological tolerance for risk. And for most of us, that's the number. 20% is the drop that we can deal with. So on 5 million, we can tolerate $1 million loss. And so that is really why most of the very big retirement funds and big balanced unit trusts will try and aim for that balance of 60% in shares and then the balance in bonds. The risk management can get a bit better, especially when we start to say, why don't we allocate half of the investment overseas as well, and then in a very similar mix in 60% shares and 40% bonds. And if we do that, what we find is when the markets, especially globally, have a big crash, the losses are a little bit less severe for us in South Africa, because what happens is the rand acts like a really nice shock absorber. So instead of losing 20%, we end up losing somewhere around 10 to 15%. So even our beloved rand actually does have some benefits for us in a situation like this. So that 60-40, Stephen, is very simple. 60% shares, 40% bonds, ride it out, and then your losses get a lot less. Your recovery might take a little longer, but the point is you actually form the ability to stay invested. And that's really the whole key to this whole business is, how long can you stay invested and let your money generate the money babies that we need to get that compound growth?
How do we end up with the balance of 60-40? Why does it seem that the classic portfolio is 60% of your money in shares and 40% in bonds? I mean, I presume it's classic for a reason.
It is, and it's because it's almost the most the largest amount we can have in shares. So in an ideal world, if we all operated like robots and we didn't have emotions, we would remain 100.
Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
% in shares all the time and wouldn't be affected by the drops. But because of the psychology of human beings, the 60% is pretty close to the maximum that most of us can tolerate before we get very uncomfortable during a big market crash. And so, I guess it's an iterative process over time. Fund managers and investors have found that this is the point where we can tolerate the losses and still benefit from the growth. So it's almost, if we were building a car, 60% is the size of the engine. That's the biggest engine we can possibly put in the car before the brakes and the suspension and the shock absorbers and the airbags fall apart, and that's the 40%. So bonds, the thing to understand about bonds, especially globally now, is that bonds tend to move in the opposite direction to shares. So when shares are doing very well, bonds are not going to be such a good performer. And then we'll really be unhappy that we've got a bond exposure at all. But when the world falls apart in the stock market, then you see the price of bonds go up. And a rising price is very good for investors. It's the shock absorber that helps at least to limit the losses, or sometimes it actually makes some money. And that's really what we're seeing now on the international markets is bond prices are generally rising because interest rates are generally falling. So even though the stock markets are responding very badly to Trump every time he opens a social media account, the bonds are giving a lot of stability.
Okay, so the bonds give stability. I mean, I keep seeing stories about how bond yields are up, and that surely means that people who are buying bonds are very worried as well. I mean, there's a lot going on at the moment, and shares and bonds are both being affected.
They are. And so when you see a bond yield going up, the maths gets a little bit complicated here, because that means that actually the price is falling. And that's because investors, maybe just to talk about America for a second, because it's really in America where we're seeing this happen. And what's happening in the States is investors are getting a little bit worried that America might not be able to service all of its debt. And so they're not buying the new bonds that are being issued by the American government, and so the price is falling, and that causes the interest rates to rise. And the American government desperately wants interest rates to be low because they have to keep paying back all the debt that they've taken on, and so they want the price of bonds to be high and the interest rates to be low. That's not happening right now, and one of the reasons is around the tremendous instability that Trump has brought into the market. Every time he opens his mouth about 50% tariff on Europe, or he attacks the Reserve Bank governor in America, the Federal Reserve governor, he causes instability, and that's actually really bad for bond prices and counterproductive to their whole strategy. But in general, because you can now earn a nice interest rate on bonds, it has become a very nice diversifier away from the stock market again, which wasn't the case from 2008 all the way until kind of early 2022, when interest rates were pretty much zero and bonds were a terrible place to invest.
That was Warren Ingram's expert advice on diversification and how that serves as a valuable guide to building a resilient investment portfolio and achieving long-term financial success. An investment school, Stefan Engelbrecht, portfolio manager for Mazi NextGen at Mazi Asset Management, and Chris Eddy, head of investments at 10X Investment, sharing their expertise in global trade dynamics and its implications for your retirement portfolio, exploring whether offshore investments remain a smart play in today's uncertain landscape.
It almost feels a little bit like a Netflix political thriller almost, where every episode ends on a bit of a cliffhanger, from those escalations to the de-escalations to the court rulings yesterday. So you're absolutely right. I mean, I think, though, one needs to take a look back, and even if we take into account some of those court rulings yesterday, I think that now brings the effective tariff rate down from somewhere in the mid sort of 25% down to about 6%. But what was quite interesting about that ruling is, even though it removed a number of the tariffs that were implemented under one piece of legislation, the ruling actually pointed out two other pieces of legislation that the administration can use to implement their tariffs. So I certainly don't think we're quite at the end of this roller coaster. But when you take all of that uncertainty that we've seen in markets and you actually look at where the market is, as you rightly say, it looks like the market's kind of ignoring a lot of this uncertainty. I mean, you have the S&P 500, so US equities are positive again after being down close to 20%. But what that does mean in an environment of much more elevated uncertainty, we are back to the position where we are at the start of the year, which is exceptionally high valuations in the US, sort of in the 90th percentile, with an environment that certainly isn't as positive as we were in there. So there certainly is some need for caution.
Yeah, I mean, the sort of end of US exceptionalism. Stefan Engelbrecht, I mean, is ignorance bliss? I mean, can you really ignore Trump? I mean, he was easy to ignore on The Apprentice, but I don't know if he is now.
No, it's definitely not easy to ignore him, Stephen, and thank you very much for inviting me on the show again. But it's not easy, but it's probably the right thing to do. And it's not as though he's not going to impact your portfolio, but you have one of two options. You're either going to second guess and try to predict what he's going to do, which I think is even more difficult than trying to ignore him. Or you can just stick to your process and decide how do you want to invest and just go through it. And I know it's very difficult quite often, especially with all the media talking about it all the time. You just highlighted that as well. But stick to your process, continue. The economies tend to find a way. And if you just keep to your process, that will probably be the best outcome for your portfolio.
I mean, Eddie, a couple of points to all of this. One is, there is a cost, as you say. I mean, there's the certainties out the window, and just that imposes a big economic cost. But I think the other challenge during these times is to try and ignore the noise. And I mean, often in investing, you want to ignore the noise. I mean, so often we're told, ignore the day-to-day, look at the long-term stuff. And Chris, isn't that now actually the most important thing, is to actually, you've got to really focus on that, ignoring the noise?
That's completely right, Stephen, and I'll agree with Stefan's comments as well. I mean, so the way we think about it, certainly when it comes to investing for your retirement portfolios, you're not investing for the next 3 months or 6 months or even the next year. You've got a long-term time horizon looking out the next 5, 10, 15, 20, maybe even 40 years. And so when you take that type of time horizon, you do have the ability to try to turn down the noise. But what does become very important over those slightly longer term time horizons is this concept of valuation, because valuations aren't that powerful. They're terrible timing tools. They don't help you with understanding where returns are going over the next kind of year, but they are pretty powerful when you look out over the next 5 to 10 years. And you mentioned it earlier around sort of US exceptionalism, which was really the kind of the end and end all at the back end of last year. And obviously now what's become a lot more popular is this sort of concept of potentially, are we at a sort of a potential turning point at the end of US exceptionalism? But if you do quiet down the noise and you purely look at long-term valuations, you have the US, which is sort of sitting at sort of a 90th percentile valuations, almost pretty much double the rest of the world. And maybe there are, for long-term investors, potentially more fertile grounds outside of the US. And as you bring that back home and think about building a South African retirement portfolio, often questions are, we need to diversify SA-specific risk. And what do investors do? They typically go off and invest in something like the MSCI World or global equities, global bonds, which typically has a very high allocation to the US. And that's worked incredibly well over the last 10 to 15 years. But often what's worked over the last 10 years doesn't necessarily work over the next 10 years.
Stefan, I was reminded today that there's roughly R1 trillion that companies are not spending, that they could invest, but they aren't in South Africa. And for years, people have been, get your money offshore. Is that still such a good idea? And let me just make this point. At least if you're in South Africa and are South African, you understand what you're getting into. I couldn't tell you what on earth we're getting into in the States right now.
Yes, that's definitely the argument for investing local. I'm definitely not somebody that says you shouldn't invest in South Africa because of, political reasons, or I am more of you have to diversify your portfolio. It is completely, to be in an economy that is, a 3 or 4% of the global economy, if that match. I think it's much less, sorry. I think that's the weighting in the emerging market index. To have all of your money in such a small economy just doesn't make sense. So you have to diversify and stick to your process, and then even on diversification grounds. So if you want to diversify into global markets, into South Africa, stick to that process. It's very tough and difficult to time these markets to stay. So the American market is now going to outperform for 15 years. Now it's the European market is going to outperform, or China is going to outperform. To my mind, it's to have a very good balanced basket and to continue to contribute for it. If you're a value investor and you find valuation metrics very important, stick to that valuation metric and don't try to flip-flop and become a growth investor and then a value investor and so you continue to flip-flop from one investment style to another. Be consistent in your process, and that will probably be the best outcome for your portfolio.
Obviously, Stefan, diversity we know matters, but it used to just be, diversity means taking money out of South Africa and probably putting it in the US. Now, you can't just put it in the EU and you can't just put it in China. You need to really, truly be a geographically diverse.
That was always the case. I just think a lot of people got away with it. They forgot about it and they got away with it. And a lot of that was luck. I mean, I think very few people forecasted in 2010 that the US is going to outperform the way it did over the subsequent 15 years. And people have to realize that a lot of the investment environment comes down to just continuously following your process, and sometimes you get significant winners like the US market, and you get draggers or laggards like the UK, that's been a terrible laggard, or Europe, South Africa, although South African market has picked up quite nicely recently. It has been a good performer. But overall, just continue to have a nicely diversified portfolio and try to forget about the noise. It's difficult, but do it.
Chris, Eddie, I mean, when you look at the sort of South African versus global allocation, I mean, how do you balance that? And yes, there was the rally last year that came off a little bit in South African stocks and stocks that are really exposed to our economy. But, I mean, do you see a big need at this stage to kind of change the allocation?
So it's quite interesting. So when you think about building long-term wealth, what matters is your return above inflation. So if inflation's running at 10% and you hit 10%, you're going nowhere in real terms. So really, when you're building your retirement portfolio, you need to evaluate that relative to inflation. And a symptom of some of the challenges that we have in South Africa, certainly around some of the risks in terms of our fiscal trajectory, is that we have exceptionally high real rates here. You can invest in South African inflation-linked bonds and almost secure inflation plus 5% over the next 5 to 10, 15 years. And if you think about that, over the really long term, looking back over the last 100 years, South African equities have given you about inflation plus 6.5%. So we're sitting today in an environment where something that is typically quite a defensive asset class and over the very long term has given you sort of inflation plus 1.5% is offering you inflation plus 5% because of the specific dynamics in South Africa now. So there certainly is some great opportunities in the local market, but I agree with Stefan here in terms of stressing the point around ensuring that you are well diversified, not only across asset classes, but across geographies. Because I think in terms of like a global markets, it's about 30 basis points that South Africa makes up when you include developed markets. So we really are a small drop in the ocean. And you know what, there are very real risks from a South African perspective. So it is important to diversify globally. But having said that, there are still great opportunities, and sort of South African bonds, South African inflation-linked bonds are a great example of that. When you bring it back to the goal that you're looking to achieve, which is for us, when we think about saving for retirement, it's trying to hit a hurdle of about inflation plus 5 to 6.
We're speaking to Chris Eddy, Head of Investments at 10X Investments, and Stefan Engelbrecht, Portfolio Manager for Mazi NextGen at Mazi Asset Management. Short recess for Investment School. Back in a moment.
The Money Show.
Investment School.
8 minutes to 8 the time. You're with The Money Show. We, of course, talking about how you manage investments during these very troubled trade times. Chris Eddy, Head of Investments at 10X Investments. Stefan Engelbrecht, Portfolio Manager for Mazi NextGen at Mazi Asset Management. Chris, obviously, you know, from time to time, well, actually, quite often in the South African context, whenever we talk about investments, you end up talking about politics very quickly. And Trump's kind of been doing that for the US. And I remember famously one or two European people tutting and suggesting that the US was behaving like an emerging market. Can you imagine? But obviously you need to think about beyond the politics and a sort of diversification beyond politics in some ways. So at 10X, what kind of approach do you use?
So for us, we think that certainly over the long-term time horizon, investing in the right asset classes and picking the right markets in aggregate is the best way to deliver long-term real returns. So we focus all of our time there. There's some people that are very good at stock picking, but we don't necessarily see that much value to long-term investors through that process. So we typically would build a portfolio today that maximizes the probability of hitting those real returns kind of in the region of sort of 5 to 6% out over the next 5 to 10 years with the lowest risk possible. That's how we think about it. Now, what's quite interesting when you touched on people sort of really bringing up this idea of the US potentially being a sort of an emerging market. And I think what was really interesting during some of the sort of the peak market stress that we saw in early April was it's the first time that you've really seen the US dollar, US equities and US bonds all sell off at the same time. And that's something that we typically are quite used to in an emerging market like South Africa. Whenever there's sort of political risk in South Africa and foreigners dump our assets, we see bond yields rally, the equity market rolls over and the rand depreciates. And that dynamic really started posing the question to a lot of people. You've seen the US has been a major beneficiary of capital flows over the last 15 years, given its outperformance. I think post the GFC, the US made up roughly 50% of global equity markets. It now makes up something like 70% of global equity markets. And the question I think many investors need to ask themselves is, if the new Trump administration is really sort of closed for business from a trade perspective, will incremental dollars continue to be reinvested inside of the US if they're really shutting their doors? And what's quite interesting, I mentioned earlier that despite all of the volatility and the noise, the S&P 500 is flat for the year and recovered all of those losses. But if you're a European investor investing in US equities, you're still down 10% because the dollar has quite materially depreciated from its highs at the start of the year. And if you stand back and again kind of look at it from a long-term valuation perspective, not only are you in an environment where US equities are sort of in the 90th percentile, and whenever they've been at these sort of valuation levels, they really have not delivered positive real returns over the next 5 or 10 years. But not only that, you also have the dollar, which is exceptionally expensive. So as we think about diversification, and this is very much from a risk management perspective, we are not only downweighting our exposure to US equities, but we are also diversifying away into other developed markets, sort of currency exposures. You can think of things like the euro or the yen. And that certainly isn't to say we're all out of the US. It is ensuring the right balance of diversification so that you can help investors ride out the bumpy ride. Because there's one thing about staying invested for the longer term, and we know that that is key to building long-term wealth. But if you kind of panic over the short term and you disinvest when markets are down because there's a lot of volatility in your journey, that is one surefire way to not reach your end investment goal, because sort of panicking and selling out during periods of volatility is the one way to really create losses and not reach your investment goal.
That was this week's Investment School. Stefan Engelbrecht and Chris Eddy providing some expert analysis.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
702. The best of the Money Show from this week.
This week on our business book review, Ian Mann, Managing Director at Gateways Business Consultants, exploring Joseph Stiglitz's book, The Road to Freedom, Economics and the Good Society, arguing unregulated markets can lead to inequality and reduced freedom, and challenging the idea that free markets alone guarantee true freedom.
He opens the book with a very interesting thought experiment. He says the thought experiment is actually developed by the philosopher John Rawls. But he says, if you didn't know what you'd be born into in a country, you didn't know whether you'd be rich, you didn't know whether you'd be poor, you didn't know whether you'd be sick, you didn't know whether you'd be part of the majority or part of the minority, what sort of society would you want to live in that would ensure that irrespective of what you were in terms of status, you'd be able to live a free and a full life? And I think that's the starting point of this whole discussion. His book has a look at what sort of economic systems we've gone through. A large part of the book is simply talking about the background to this, and he goes back as far as feudalism in the Middle Ages. And feudalism we know of most popularly from Europe, but was also in China and Japan and a lot of other countries as well. So what happened was the king owned everything, and he appointed lords whom he gave large estates to. And the lords gave them to vassals in exchange for their loyalty and for being soldiers. And then the vassals below them had peasants who worked the land and gave the lord money, large amounts of their money, to allow them to live on the land. So in an environment like that, which is very rigid and hierarchical, all the power was really in the hands of the nobility, and there was low economic growth and slow social progress. If you were a peasant, you never ever got up to being a lord or even a vassal. And probably communism was a response directly to that. And what the communists proposed was, and what they tried to develop was a society that would give people security and also equality, material equality. They failed. They had low economic growth. There was no freedom, and the concentration of power, which simply replaced the wealthy people who was now the party. The result of that was inefficiency, lack of incentive, lower productivity, and very slow economic growth. And then capitalism comes in. Now, capitalism historically has generated more wealth than any other form of economics. The GDP is high. The tech innovations significantly better. There's improved standards of living, and all of this. I suppose if you wanted to pick up the background to the type of economics that he's repulsed by, it's probably started off with a phrase that everybody remembers from Adam Smith. Adam Smith, the economist, said that there's an invisible hand, and that the baker bakes good bread at a good price, not because he's altruistic, but because if he does that, he's going to get rich and the people around him will have access to bread at a good price. Then along comes Milton Friedman, this is in the 60s, and he was he believed that in markets, essentially, he said markets will fix everything. Communism had no free markets. He says capitalism has got to have free markets, have minimal government intervention. Markets will function best if governments just get out of the way, and we'll make this whole thing work, but only by allowing the market to do what markets do best. And that's to make as much money as they can, mainly for their shareholders, and that'll lead to better economic outcomes for everyone. So deregulate, keep the taxes as low as you can, allow people to get as rich as you can. Ronald Reagan passed a comment on that, and this was in the 80s. He said governments are not the solution to the problem.
Yeah, they are the problem.
Are the problem. Yeah. And so what he suggested, what he was promoting, and Reaganism is coming back again and again, is limited government and free market policies. Now, that sounds extraordinarily good. Here's the problem. The problem is that it has created extraordinary wealth in the world. Really, and we've never, ever had growth and wealth like this ever before in human history. The richest 1%, however, they have more wealth than the bottom 95% of humanity. So you've got a tiny group of people at the top, extraordinarily rich, and they have the money and they control 43% of the global financial assets. Now, in a world that is that split with huge numbers of people, millions of people in poverty or very low levels of economic activity, grinding out every single day to try and make a living. And capitalism doesn't sound like such a great idea. And this is where Stiglitz comes in with his new view of what capitalism should be.
Okay, so that's the critique, and it's a critique many people are making, particularly at the moment with the sort of tech bros, etc. So what does he suggest there should be? I mean, he does suggest quite an active role for government, and as I understand it, makes the point that you need government to regulate traffic lights, for example.
I think what he does importantly is the key is this: we want to regulate. And he believes that we need to have taxes. Now, if you said a country where people are free is a company where they have the vote. But if you're starving, the vote doesn't count terribly much. And if you can't live to your full potential, it doesn't do very much.
That was Ian Mann's review of the book by Joseph Stiglitz, The Road to Freedom. You've been listening to the best bits of The Money Show, a digest of some of the most important interviews, thoughts and insights from the week. If you'd like to hear more, please go to our website or your favorite podcast app and search for The Money Show. Thanks for being with us. The Money Show back with you 6 o'clock on Monday. Have a good weekend.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.